There are 4 key principles or topics that you need to be very familiar with in regards to ISA 240. In ISA 240 Part 1, we looked at the difference between fraud and error, including the definition of fraud and the auditor's responsibilities in relation to fraud. In this clip, we will look at the last 2 key areas, starting with the difference between fraudulent financial reporting and misappropriation of assets. Fraudulent financial reporting relates to the deliberate misstatements of financial statements. It is what I like to call Pinocchio's undertaking. To me, fraudulent financial reporting ultimately boils down to dishonesty in the financial statements. So the fraudster is basically pulling the wool over the eyes of the investors and other stakeholders who would rely on those financial statements. Fraudulent financial reporting is basically achieved using one or more of the 3 M's. That is, manipulation of accounting records or documents. Remember that the financial statements are based on accounting records and supporting documentation. So if a fictitious journal entry is processed, this will ultimately result in a manipulation of the financial statements. The second M is misrepresent. This relates to a distortion of transactions or events or leaving out certain information which would twist facts and mislead users of the financial statements. The third M is misapplication. This relates to the exploitation of accounting policies such that the true state of affairs are not being reflected and users will ultimately be deceived. Misappropriation of assets relates to assets. The most common examples of misappropriation of assets include theft and misuse. For example, Sam is a truck driver for ABC Movers, which is a company that transports goods for clients. The company is closed on weekends. However, without the owner's permission, Sam uses one of the trucks to provide moving services at a discounted price. He obviously pockets the extra cash that he earns. This is an example of misappropriation of the company's assets. Even though Sam did not steal the truck, he is misusing the asset for personal use and without permission. Now let's look at the last key area of ISA 240, which is the fraud triangle. ISA 240 paragraph A25 identifies 3 factors which would indicate the possible existence of fraud. The first factor is an incentive. This refers to something that would entice or encourage a person to engage in fraudulent activities. The second factor is an opportunity. This relates to a chance or opening that would allow for fraudulent activities to occur. The most common opportunity would be weak internal controls that would not prevent or detect fraudulent activities. The third factor is the ability to rationalize the wrongdoing. This refers to the ability to justify or vindicate one's actions. For example, one of John's responsibilities at work includes control over petty cash. This includes issuing cash, replenishing cash reserves, and keeping records of all cash issued and to whom. As he is a trusted senior within the organization, no one reviews the petty cash records. Recently, John has been experiencing personal financial difficulties and he started stealing petty cash. He believes that working extra hours without claiming overtime would more than compensate the company for the petty cash that he takes. The personal financial difficulties that John has been experiencing are an incentive for him to engage in fraudulent activities. The fact that he has full control over petty cash and is responsible for the record keeping provides him with the opportunity to steal petty cash and cover up his tracks by falsifying the petty cash records. No one checks these records and so the controls are ineffective. He is able to rationalize his wrongdoing by believing that working overtime without claiming it would compensate the company for the stolen cash. Thus, all 3 fraud factors are satisfied. To recap, there are 4 key areas and learning points that you should be familiar with in ISA 240. In this clip, we focused on the last 2 points, which are the differences between fraudulent financial reporting and misappropriation of assets, as well as the fraud triangle.